Hi everyone and welcome to a brand new episode. My name is Marcus and today we're looking at AMCOR, ticker symbol AMCR. This stock is requested by Ace Milan Philip Gonzaga. Thank you so much Ace Milan Philip Gonzaga for reaching out, commenting and requesting the video. If you're watching, please let me know in the comment section below. I hope that you guys will enjoy this episode, and if you have any questions or have stocks you want me to do a video on, please let me know. So we will cover the income statement, balance sheet, cash flow, key figures, our key feature, and a technical aspect of the stock. Now, should we be buying? Well, let's find out. So AMCOR is traded on New York Stock Exchange and are in the manufacturing sector. If we go down to the screen, we can see that their market capitalization coming in at $17.5 billion and their revenues at $13.6 billion and the PE ratio coming in at 18.6. Now, guys, I like companies with a PE ratio of 20 or below. So I have an 18.6. That is within the range. So that is a goal for me. I like that. Now, whenever you see a stock with a high PE ratio, what does it tell us? Well, it tells us that market expectation of that stock is high, and therefore there are good chance that you see capital gains on those stocks because there's a lot of investor pushing the price even higher because they are expecting better and better numbers. But at the same time, the overhanging risk is if the company cannot meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. Basically, what that tells you is that the market expectation of that stock is low because there is not a lot of expectation from those stocks. So just keep that in mind. Now, the profit margin coming in at 6.9. Normally, I like companies with a profit margin of 15% or higher. So 6.9, that is a bit too low for me. So that is a no. Price to sales ratio coming in at 1.2. That is within the range because I like companies with a price to sales ratio of maximum 4. So 1.2. I like it. So that is a go. Price to book value coming in at 3.9. Normally, I like companies with a price to book value of maximum 3. So 3.9, I understand. I get it. It's not far from the threshold, but still higher than what I normally like to take a look at. So that is a no for me. So if we were to summarize, PE ratio within the range, price to sales ratio also within the range, but price to book value makes it overvalued, so that is a no. But let's look at the they pay out a dividend of 47 cents per share. I like it because I like those recurrent income, and the effective return at 4%. I like it, so that is a goal for me. But guys, I want you to be very cautious. Whenever you see a stock with a high effective return, be very cautious here because it could be a trap, meaning that you might get good returns as long as you own the stock, but whenever it comes time for you to exit the stock, you might not get a higher price than what you bought it for. So make sure to go through the business, look at the chart and see, is this business consolidating or is it moving in a negative trend channel or a positive trend channel? And what is my exit strategy? When will it be time for me to exit the stock? How will the economic climate look like and where will the business be? So make sure to keep that in mind and be very cautious and don't just jump the gun because you see a company with a high effective return. About 4%, I like it. Now, a return on equity coming in at 20.5. I like it because the return on equity, basically what it tells you about companies' ability to create return on their equity. As for an investor, you want to make sure you have a company with a positive return on equity because that tells you that they are able to create return on the capital you're about to invest in them. So make sure you have a positive return on equity. I like this one. So that is a goal. Return on assets coming in at 5.5%. That is a bit low. I would like to see a range at least at 10%, but 5.5, that is a bit low, so that is a no for me. So the stock is currently traded at $11.6 per share. And if we go down to the moving average, we can see that we are above the 50-day moving average, but below the 200-day moving average. This tells me that the indicator, there is uncertainty here. And the indicator cannot tell us whether we'll see the stock price increase or whether it will decrease. But if we take a quick glance on the chart, we can see that we have been moving or consolidating for quite some time. But we'll take a closer look at the technical aspect of the stock further down. Let's head over to the income statement. And what we're interested here is that the total revenue, and we can see it went from $9.5 billion in 2019 up to $12.7 billion. And these numbers have been growing, so that is a plus. I like that. Gross profit went from $1.8 billion up to $2.7 billion. And these numbers have been growing. That is a plus. Net income went from $430 million up to $939 million. And these numbers is growing. I like it. I'm liking what I'm seeing right here. Now let's head over to balance sheet. And what we are interested here is that the current assets versus the current liabilities. And we can see that there is a difference between the current assets and the current liabilities. Basically, if the company were to convert their current assets to cash, they're able to pay off their current liabilities, and that is a plus. But they are far from being able to pay off the total liabilities, and that is a negative. If we take a look at the total liabilities, we can see that it went from $8.4 billion up to $12.4 billion, and these numbers have been growing, so that is negative. I would like to see them reduce their total liabilities because of the economic climate we're in right now. The interest rates are growing, so we don't want a business that is not taking care of the total liabilities. So I would like to see them reduce the rate which the liabilities are growing. But let's look at the numbers of outstanding share, and we can see the number of outstanding share went from 1.2 billion shares up to 1.5, and these numbers have been growing, so that is negative. Basically, what is happening here is that the company is issuing more and more share, meaning that your share of the company is decreasing. You're being diluted as investor. But if we were to see these numbers drop, that would mean that the company are doing buybacks. They're buying back shares, meaning that there are fewer and fewer available shares out there, making your share of the company grow. And as always, guys, there's a lot of investors that either skip this part or doesn't know about it because they be looking at a company's balance sheet and see a company with a lot of assets and the debt is not growing, which is great, which is amazing. That is what we're all looking for. But on the other hand, we can see that the business are issuing more and more shares, and that is negative because they are diluting their investors. But at the same time, that's a way for a company to bring in more capital without taking on more debt. So make sure whenever you be looking at the balance sheet, don't just be looking at the assets and the debt. Make sure that you include the number of outstanding shares. Now, let's jump over to the cash flow. And what we're interested in here is that the operating cash flow versus the capital expenditure. And we can see that the operating cash flow came in at $1.5 billion and the capital expenditure at $468 billion, making a difference of $1 billion, and that is a plus. And we see that operating cash flow went from $776 million dollars up to $1.5 billion, and these numbers have been growing. The capital expenditure went from $332 million up to $468, and these numbers have also been growing, so that is a plus. I like it because I like that the cash flow from the operations are improving, also that they continue to invest in the business. That is amazing. Now let's jump over to the key figures. What we can see here is that the earnings per share went from 34 cents per share up to 61 cents per share, and these numbers have been improving. That is a plus. Revenue per share went from $7.56 up to $8.29, and these numbers have been improving. That is a plus. Equity per share went from $4.48 down to $3.10, and they fell off 1 year and then it got back up, but there is less than what we started off with, so that is negative. Dividend per share went from 54 cents and then they cut it to 48, but that is a plus because I like dividends, because I like those recurring income. It's too bad that the income is not growing every year, but I like those recurring income, so that is a plus. Dividend share went from 158%, 124, 79. I don't like this at all because I like companies that pays out less than 60% of the capital, because I want some of the capital to remain in the business for investments, for acquisition, or just strengthen the business for uncertainties. So seeing these high numbers, I don't like it at all. They need to cut this to at least 20%. Gross margin went from 19% up to 21.4%, and these numbers have been improving every year. That is a plus. So basically what this is telling us is that the business is becoming more and more efficient, and that is a plus. But at the same time, we need to compare these numbers across the industry and see how is AMCOR doing compared to their competitors. But seeing that these numbers are improving, I like it, so that is a plus. Operating margin went from $6% up to 9%, and these numbers have been improving. That is a plus. Profit margin went from 4.5% up to 7.3%, and these numbers have been improving, so that is a plus. Return on equity went from $7% up to 19.7%, and these numbers have been improving, so that is a plus. Return on assets went from 2.5% up to 5.4%, and same thing here, these numbers have been improving. Solidity tells you about a company's financial strength for a long term, and we can see here that it went from 32.6% down to 27%, and these numbers have been dropping, so that is negative. Balance sheet liquidity tells you about a company's financial strength for the short term, and we can see that it went from 0.75 down to 0.66, and these numbers have been dropping, so that is negative. Debt ratio went from 2.0 up to 2.6, and these numbers have been increasing, so that is negative. Basically, a debt ratio of 2.6 means that the company has 2.6 times more debt than equity in the business, and seeing that these numbers are growing, so that is negative. Guys, we have gone through the income statement, balance sheet, cash flow, key figures. Now over to a key feature, which is the stock analyzer. And what the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we go down to the screen, we can see that the PE ratio is below 20, which is great. They pay out a dividend, which is great. And the dividend payout share is greater than 60%. That is negative. And dividends increased over the past 5 years. Now they haven't increased, so this I have to report this. That is negative. Number of outstanding shares have increased. That is negative. Revenue increased over the past 5 years. That is positive. Profit margin below 15%, negative. Profit increased over the past 5 years. That is positive. Current assets are greater than current liabilities. That is positive. Solidity increased over the past 5 years. That is positive. Balance sheet liquidity decreased over the past 5 years. That is negative. And debt equity ratio decreased over the past 5 years. That is, I have to report this. That is not correct. And total liabilities have grown over the past 5 years. That is negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. And you can have the software along with everything we've gone through for only $10 per month, plus access to our discussion forum where you'll be able to chat with me along with other members. So head over to commerce.sc and become a member today. Okay? Thank you. Now let's jump over to the technical aspect of the stock. So here we have the chart. Let me just lay down the support line, something like that. As we saw earlier, we are consolidating. Let me change that color to green, and let me do one more resistance line, something like that. And let me change that color to red. Okay, guys, as you can tell, we have been consolidating since July 2020, and we have seen these numbers ranging. We even broke out of the channel and then fell back down, but has since seen a movement. We are more or less consolidating. So should we be buying the stock right now? Well, we need to compare the business across the industry and see how's AMCOR doing compared to the competitors. But as I mentioned earlier, a effective return of 4%, that is a great number. But at the same time, we want to make sure, are the business consolidating? Is it moving within a negative trend channel or a positive? What is our exit strategy? Will we be able to exit with a higher price than what we bought it for? So we need to ask ourselves all those questions. And what is the trajectory for the future of the company? Will we be seeing higher numbers? And with the current economic situation, what will happen with the interest rate and the company's debt and the low consumer confidence? Will we be seeing that the stock price continues down below this area, even break below this area? Because it has happened before, so we need to be very cautious here. So what I would do is I like the fact that they pay dividends, but I don't like the fact that they pay out so much. I would like to see them cut it to 20%. And what would happen, I believe, is a lot of investors would sell their stock, seeing that the stock price continued down. But overall, they have good numbers, but they need to improve their finances, in form of the balance sheet solidity and the debt ratio. But overall, the numbers are looking good. I like it. So what I'll be looking at, what I would do if I were to buy the stock is I would wait for the price to range within the channel, buy over here, down here, and just earn those dividends. But at the same time, if we were to exit, let me see here, a price move of 11%, 10%, that is not a lot. That is not a lot. So what basically, if I were to buy this stock, what I would do is be buying down here and just earn those dividends and just accumulate more and more and more and more shares. And eventually, when I have enough shares, I would be exit the stock by selling it up here, something like that. So that's what I would do. So, if I were to summarize my thoughts of the company, the revenue and net income is growing. The current assets are greater than the current liabilities. I like that the cash flow from operations are growing. Also, the fact that they are investing in the business. There are a lot of positive things about the company. I like, for instance, that the gross margin is improving as well as the operating and profit margin. Return on equity and return on asset is also improving. So, what are the things they need to improve? Well, they need to improve their solidity, balance sheet liquidity, and the debt ratio. Basically, they need to improve their finances for uncertainties. The dividend payout rate is too high. I would like to see them reduce it to at least 20%. The total liabilities are growing as well as the number of outstanding shares. So the question we're all asking ourselves, should we be buying? Well, the economic climate short term consists of a lot of challenges ranging from high inflation rate, potential recession, increasing interest rates, and we are already seeing a lower consumer confidence due to high inflation. But at the same time, we are seeing a lower unemployment rate. U.S. job vacancies are dropping, meaning that companies are finding workers and labor market participation is improving. So there's a lot of uncertainties, and therefore short term, we could have a bumpy ride ahead of us. But long term, I think AMCOR is a potential stock to add to the portfolio. So if I would score the company, I would give them a score of 65%. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below. And also let me know if you have any questions or have stocks you want me to do a video on. And as always, please do your own analysis. Thank you so much for watching. I am truly grateful and I appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe. And until next time, guys, take care. Bye-bye.